If you have been thinking about going from an employee slash self-employed to a corporation environment, you need to watch this. Here you are, you're operating a business and you probably started out, I'm just going to give this a shot, see how this goes. And you realize, oh, that I'm onto something here. It's working. And one of the things you did when you first started was you wanted to validate your concept. You wanted to put it through a process of making sure that it actually is a viable business before you invested the time and the money going the whole corporate angle for the setup. What have you done? Essentially, imagine a scenario, split down the middle. You have corporations on this side and you have personal on this side for income tax specifically. We're going to get into income tax almost exclusively in this chat. These guys bring in revenue. These guys bring in revenue, right? Money comes in somehow, some way through the business. And depending on whether or not you're on this side of the fence or this side of the fence, you will have different tax consequences. This one comes with setting up costs, annual costs, and things like that. This one is strictly like, it's so simple. You just add on revenue and you keep doing what you're doing. The numbers in the spreadsheets could change, but there's no fundamental difference in how you organize yourself. The big differentiator to me is on the personal side. In Canada, when you exceed 235 grand or so, you pay 53.53% of what you earn beyond that in tax dollars. Let me repeat that. You pay 53.53% of what you make in income towards income taxes when you exceed that threshold. Before that, sure, it's not that high. Not as high as 53, but it's definitely high. On this side here in the corporation environment, if you earn money directly into the corporation, the first $500,000 of revenue earned by a Canadian-controlled private corporation, which is what you would probably have, the first 500 grand, income taxes are charged at 12.2%. As high as 53.53, as low as 12.2%. This distinction between self-employed corporation is massive. There are issues beyond this, but at the very root level, foundational, fundamental level, it's important you understand how this is treated versus how this is treated. Now, you have life expenses, right? You've got to figure out how to afford life. And when you pay for things for life, you pay for it with personal dollars. So the problem becomes, how do I get this money, corporate dollars, how do I get this across this line into the personal side so I can go ahead and spend it? Because if you take it directly from the corporation and you pay personal stuff, it's treated the same as if it went through this imaginary line and then that's income to you personally. Whenever you move money from your corporation to yourself personally, the net effect of doing that, of taking money this way and then spend it, is basically as if you had earned it directly in this category. So you got to be careful as to how you move money between these things. So there's tons of strategies, and what makes sense for you is going to be dependent on what you do, what your spending is like, things like that. But understand that when you operate in this very simplistic, very easy framework of just earning in a self-employed, you are exposing yourself to significantly larger tax liabilities. What doesn't matter is how much you make. What matters the most is what you're left with after you're paying your taxes, how much you keep. With that in mind, it's important that you consider structure between personal and corporation so that you can maximize what it is you get to keep.